Today, we're diving deep into one of the most mysterious and often misunderstood investment products to hit the financial markets in recent years, Snowball Structured Products. These complex, high-return instruments have quietly amassed over $100 billion in annual sales in China alone and over $2 trillion worldwide. But when markets turn south, snowballs can explode into forced liquidations, wiping out fortunes overnight and even accelerating broader market downturns. In this episode, we'll unpack what snowball products really are and how they're structured, why they became so popular among high net worth investors, the mechanics of knockout and knock-in triggers, how leverage can lead to catastrophic liquidations, and why bank hedging around these products can amplify market sell-offs. So buckle up. This will get technical at times, but if you stick with me, you'll come away with a clear, professional understanding of snowballs and their role in modern markets. Let's get started. First, let's clear up a common confusion. Snowball products have nothing to do with that snowball media platform you might have heard of. They're a type of structured product, a concept that traces back to the US in the 1980s. At their core, structured products are simply a combination of a bond, which you can think of like a bank deposit paying fixed interest, and a derivative package, usually options, tied to some underlying metric such as a stock index, currency, or interest rate. Imagine you want more yield than a 3-4% bond but can't stomach full stock market risk. You approach the structurers, the team of PhDs and quants at an investment bank, and say, I want capital protection plus a kicker if the S&P 500 rises, capped at 30% over 3 years. They package a zero coupon bond to guarantee your principal with call options on the S&P 500 to deliver exactly that payoff profile. If the index rallies, you get the capped upside. If it falls, you still get your principal back at maturity. You may recognize this as essentially long bond plus long call, but real-world structured products get far more intricate, tracking multiple stocks, incorporating path dependency, autocall features, barrier knock-ins and knockouts, you name it. The key point, they're bespoke. If you can describe the payoff you want, structurers can engineer it. Why are these sold almost exclusively to high net worth individuals? For two main reasons. Complexity and disclosure. In the US, investors in these products must sign off on lengthy risk disclosures, often well over 100 pages. That discourages retail uptake. Minimum investment thresholds. In the US and Europe, you often need $1 million or more. In China, thresholds start around wider 1 million and go up to $100 million. High net worth clients receive invitations from private bankers or wealth managers. They're approached with a tailored product, maybe the next issue from Goldman Sachs promising 18% annualized yield. If they want a custom kicker, say 20%, the bank will build a unique tranche just for them. These issuance desks are among the highest return units in banks. They charge compound commissions and hedging fees, often slicing off 2 to 3% per annum of the theoretical payoff. That's why professional institutions rarely buy them. They can replicate the payoff synthetically at far lower cost. But individual investors, dazzled by headline yields and lacking derivative desks, pay up. Now, Snowball. This specific structure surged in Asia over the past few years. The simplest snowball is a 2-year bond paying, say, 15% annualized, with barrier levels defined on an index like the CSI 500. There are two critical barrier prices, a knockout level at 103% of the starting index and a knock-in level at 75% of the starting index. For example, if CSI 500 starts at 5,000, monthly observations look for a close above 5,150. If hit in any month, the product auto-calls, returning your principal plus coupons accrued pro rata, 7.5% if called at 6 months, 30% at maturity. If the index never touches either barrier, you get full 30% at maturity along with your principal. But if at any point the index closes below 3,750, the knock-in barrier, and never recovers to knockout levels, your payoff mimics direct index exposure. You lose exactly the percentage drop in CSI 500. Full 10%, you get back 90% of your capital. Full 40%, you get back 60%. So snowballs are effectively short put options with an auto-callable kicker, offering high probability small gains, 15% PA, and low probability large losses. That asymmetric risk profile, high chance of modest profit, small chance of big loss, is very enticing until markets crash. Here's where it gets dangerous. Many investors buy snowballs with 3-4x leverage. If the index breaches the knock-in barrier, brokers issue margin calls immediately. Unable or unwilling to top up, investors face forced liquidation, losing every cent. Mr. Tang, a high net worth client, learned this when CSI 500 dipped below 75%. His entire Y2 million position evaporated overnight. That's the retail story. But in the broader market, another dynamic kicks in, the hedging activity by banks. When snowballs are issued, the issuing bank must delta hedge by buying or selling index futures to offset their exposure. As long as CSI 500 stays above knock-in, the bank's delta exposure is negative. As the index dips, they buy futures, buy low, and as it rallies, they sell futures, sell high, a natural volatility dampening effect. However, once the index falls below the knock-in level, the bank's delta flips sign instantly. They need to sell a massive block of futures to neutralize their risk. If thousands of snowballs across the market knock in around the same barrier, banks collectively dump huge volumes of futures, exacerbating the market decline in a self-reinforcing loop. That's exactly what happened this year in the A-share market. In early 2025, CSI 500 surged above 6,500, knocking out prior snowballs in droves. Investors rolled into new snowballs at similar entry levels, with knock-in barriers set around 4,175. When the index slumped below that zone, a tidal wave of hedging sales hit the futures market, driving CSI 500 and CSI 1000 down harder than the CSI 300 or SSE composite. The snowball effect of forced bank hedges turned a correction into a crash. Of course, snowballs didn't cause the crash, but they certainly amplified it. Similar phenomena unfolded in Hong Kong in 2017 and Korea before that. Yet issuance volumes keep growing because banks profit handsomely from fees, and it's an attractive financing method for them, akin to issuing bonds. To wrap up, Snowball Structured Products blend bonds and exotic options to deliver upside-capped, capital-protected payoffs until they're not. Leverage multiplies investor losses, while bank hedging can fuel broader market declines. If you ever consider a snowball or other complex structured product, remember to read the fine print, understand the barriers, and be prepared for both autocall windfalls and worst-case knock-in scenarios. Thanks for watching. If you found this deep dive helpful, tap the like button, subscribe, and hit the bell icon for more expert breakdowns of today's hottest financial products. See you next time.